For our audience, I just want to share that, there's something called long short, which is also called as absolute strategy. This is also called as hedge fund in the global economies. Now, when you look at the global economies, especially the US markets and some of the other developed UK markets, this has strategy is very, very successful, and some of them have been running it for over 1.5, 2 decades, and these are pretty sizable strategies. But when it comes to India, this was, I think, very new. Like a lot of investors, generally they have the habit of investing in arbitrage fund if they have some money for 6 months or 1 year or 1.5 years. But they've never tested this. So at what I feel is a lot of work is going on here, and a lot of work is already been done by Helios. So today's agenda of discussion is to showcase what is called long short fund, for which I have requested Dinshaw to share his thoughts on, and then talk about the journey of long short fund at Helios. So over to you, sir.
Thank you. So because basically, let's understand one thing. There are two sets of long short funds. One are called pure absolute return funds. There are actually three types, actually, if you will. One are pure absolute return funds, which are more or less market neutral. So they'll have probably 90 long, 90 short, and as a result, it's like more or less zero, very close to the index is what they will. Not even close to they will give you certain absolute returns even in a down market, or in an up market, they'll give you margin. They will not be able to capture the upside, but they will not even fall on the downside. So basically, they'll be more or less somewhere there, right?
Yeah, so it's basically a replacement of fixed deposits in India.
Not even that. It's probably debt minus to that extent, because in India the debt levels are much higher. The debt
minus. So
right. It's more of a US based product, where the debt at that point in time used to be around 0.25 and 0.5, and so it was for those guys who wanted to diversify beyond debt, that kind of a product. So which is not valid for India. That's our gut feel, right? So that absolute return product is not what is meant for India, because in India the market is also volatile. Your debt is also giving higher returns. So that way, the second set was more of a debt plus kind of a product. Now that product was mainly a 20% net or 25% net. I mean, there'll be probably 100 long, 80 short, or even 60 long, 40 short, and the rest money in debt and stuff like that, right? So that was the way the product was formulated. In our case,
the second category, non-leverage, like it will have only 100 to 100 investment, right?
Yes, non-leverage, totally non-leverage, because their shorting will be more or less probably an index short, or keeping cash as a short, as a hedge. So that would be the case here. But in our case, when we started, we said we have to be different, right? That's what I told you, that we did a lot of data crunching, and we realized that the best way to play India is to have a equity plus product with a lesser net. So basically, you cut out the volatility from the movement, and as a result, let me give a mathematical example just to make you understand. Suppose the market corrects 20%, right? One guy who's like totally 100% invested to the market, he falls to 100, becomes 80. What if we just 0.9, I mean, on a beta front? So you'll from 400 to 0.9. So ultimately, what is the logic of hedging, right? You cut down the beta of your portfolio by putting in a negative hedge, by actually shorting a stock, right? So so other fellow falls to 0.90, yeah, because he is 0.9 beta or whatever. For the 80 to rally back to 100, he needs a 25% rally. 90 fellow needs just an 11% rally, right? So you cutting the guy off purely on just conserving on the downside. That's what we believed it was the case in India, and that's why we played it this way. We said we'll work it this way, that we'll be a debt plus, and as a result, that's what we've done. We've given handsome returns, which have beaten most of the long only offshore funds, and also the domestic mutual funds. And I'll again share I'll just give you one slide to share, if you allow me. I'll ask you a trick question, by the way, even before. Let me put on the slide and then ask you the trick question.
Yeah, please.
This is a regular presentation, but let me straight away take you to the trick question. Yeah. So here's the question. If you know that the market is going to go up by 100% in 2 months, right? Would you prefer to buy a long only fund or a long short fund with a 60% net exposure, right? Obviously, the obvious answer, since I'm Today I'm selling a long short fund, so you may think that why am I even talking about this? Fact is that you will say it will be a long only because 100% is guaranteed.
Right.
Actually, the right answer is it depends. Since I told you about the volatility bit, now let me share that with you. Let me actually share that with you.
Sure.
Now, this is a pure long only fund with 100% exposure to equity, right? So the market moves, say, in the first month by 900%. So the 100%, 100 rupee will become 1000 rupees, right? That's how it will be. But the next month, the market corrects 80%. So your 1000 rupees becomes 2000 rupees in the next month, right? 200 rupees.
200, yeah.
200 rupees, yeah, in the next month. So as a result, your 100 became 200 in the 2 months, but actually you lost from 1000 to 200, but still it became 200, right? Now let's look at a fund which was just 60% exposed. This is the beauty of volatility. Now suppose the first month, the market was up 900%, but you could only capture 60% because you were 60% exposed, right? So you will capture only 540% return as compared to 900% return. So your 100 NAV will become 640 NAV. But when the market corrected 80%, you will again capture only 60% of the downside, which is 48%. So your 640 will become 332, or rather 333 if you want to round it off as such. So you're better off in a long short fund than in pure long only fund. This is what volatility is all about, right? So then I told you we did a lot of data crunching. Yeah. So let me tell you this is the same thing. What the data crunching we did was this. So when we started off, we took the historic data actually, but today, since we have the live data in front of us, I can share that with you.
Sure.
From June of 2005 till today, which is, I think, November end is what we looked at. There are 208 months of returns that have been captured in this 17 odd years, right? Now, a period return is normally what? P1 into P2 into P3 into P4, where the period is represented by P and the month is by 1. You can multiply the months altogether in a sequence. But since it's a multiplication, it does not matter. The sequence does not matter. So you can multiply P1 by P100, P100 by P7, P7 by 120 and stuff like that and still get the same return, right? That's how it is. It's a multiplication, so it doesn't matter. So what we did was we said, okay, let's try and bake up this monthly returns into positive months and negative months. Put both the buckets aside and then multiply these buckets together to arrive at a return. So, for instance, in the case of a US, the S&P 500 had 141 positive months and there's 208 odd months, right? The cumulative return which they generated in this positive return months was 7,837%. So basically, your 1 rupee in a positive, only in the positive months became 79 rupees, right? 7,800%. Okay. But look at what happened in the negative months. They had 67 negative months in which they lost 94% of the returns that they generated in the positive months. And as a result, they were left with only 368% in the period return, right? So 94% into 7,837% will roughly give you 368 odd percent, right? That's how it is. So basically, you lost so much and you were left with roughly around 5 rupees. I mean, rather from 79 rupees, it came to 4.5 rupees to be more precise, right? So that was on US. But now, on the same time period, look at the data that comes out of India. It's mind-blowing because you can't even guess the numbers that we are dealing with out here, okay? That's why I say India volatile market, perfect for long-short funds. Okay, here it is. So the orange line is basically the volatility that we saw in the US. Look at the dark line, which is India's Nifty, okay? S&P 500, India's Nifty only, yeah, sorry. So look at the number. The Indian market had 126 positive months in this time period. The return in the 126 months was 43,245%. So basically, a 1 rupee invested at the time of the beginning of this run would have yielded you 434 rupees straight away, right? That's the kind of positive returns you made in the positive.
432 times, right?
Yeah, 433 times actually, because it's 30%, right? 4,330 to 43,245%. So you'll have to add one if you took in the number
Right.
of times. So it becomes 433 times, 433 and a half times is the return that the market made in the positive months.
From which
But
year to which year, sir? This one?
this is from July of 2005 till November of 2022.
Almost 17 years.
Yeah, almost 17, over 17 years, rather, more than 17 years. But
Right.
that's all. So 208 months. Look at that way, right? So we're saying that 126 positive months yielded a return of so much. Look at the negative months. There were 82 negative months, more higher. Again, the number of positive months were lower than the US, but the returns were like almost 6x of the US. Okay. The negative months were less than the US. More than the US. But look at the returns. I mean, look at the negative returns. You lost 97.6% of what you made in the positive months. And as a result, you were left with a total return of 938%. So now look at these numbers in a more roundabout fashion. Okay, let's not look at 433. Let's assume that the market that you made 400 times in the positive months, right? You lost 98% of the 400 times. So you were left at the end of the period with 8x return, right? 400 and 2% of 400 is 8, right? That is what you were left with, 98%, right? So it goes out of 100, so 2% is left. So you were left with 8x. Now suppose a hedge fund like me, he just loses, say, not 98, but 97%, right? I just conserve 1% beyond the market. We've done much more, by the way, out here. But suppose I just conserve 1%. That means my return becomes 12x as compared to 8x for the long only guy. For him to beat me, in the positive months, he'll have to move up by almost 600 times as compared to 400 times. Just to beat my 1% conservation.
Yeah, so this is turning out to be an equity plus then.
Equity plus, exactly. That is what. So let me show you the data of our fund. I mean, this is getting more interesting. Okay, so this is what I told you about S&P, basically the whole return and Nifty return and stuff like that. What I explained to you, right? This is how it works. Now, this is what our fund returns are. Okay, the Helios Strategic Fund, which is actually a long short fund, we've tried to show you the return over time periods, different time periods. So let's look at the first time period, because normally people say that 2008 आपका अच्छा होगा क्योंकि बाजार इतना गिरा था तो आपने अच्छा कमा लिया होगा उसमें. So that is what the thing is, right? So now let me show you here. From July 5 to December 31st, 2008, right? The positive returns of the index was 411 months. 411%, right? Look at our returns in the positive months. We were only 342%. So we lost out because we were net 60, right? So that's why we lost out that return. In the negative months, the market lost 73%, 74% to be more precise, 73.7 in the negative months. We lost only 68%. We conserved 6% as compared to the market. And look at our return. As compared to the Nifty return of 34%, 35%, we are of 41%. We beat the Nifty, okay? Come to the next month. Come to the next period, which is July 1, 2009, Jan 1, 2009 to November 22, which is the month gone by. In the positive months, the market gave a return of 8,378%. We again underperformed on the long side. I mean, on the positive side, we were only a 5,800% return because we were 60% net. But look on the negative months. The market lost 90.9%. We lost just 8.5%. Conserved 10% of the downside. And look at our return. As compared to the index return of 670%, we were up 160%. 1,060%. That's how the returns are. Look at the overall returns. This is what the fun part is. I shared this with you, right? 43,000% return roughly of the index. We just captured 26,000% of that 43,000% because of the 60% net. But on the negative months, the markets were down 97.6%. We lost just 93.8%. And look at our return. We 2x, literally 2x that of the index.
So I have a question here. Sorry to
Yeah.
interrupt. So
No,
this was like why 60-40? What was the logic behind the component in underlying is 60% long and 40% long short?
Right. So basically, the whole idea of the 60-40, actually, there was no this thing. We learned it along the way. Till around, say, 2007 end or something, or probably beginning of 2008, we roughly were some 80 odd percent net kind of a fund. I mean, rather 100 long, 25 short, and stuff like that. That's how we used to be. Okay. But then came 2008, and that 2008 taught us a lot of lessons because by till then, we used to think that shorting an index was a hedge, or for that matter, buying a put is a hedge, or having cash in your portfolio is a hedge. That's what our belief was, right? Everything went out of the window in 2008. We realized that markets can crap out so big that even the index can't protect you. You need to have components within to short, which can give you that additional alpha over and above the index, even on the negative side, right? So that's why we said that from now on, puts are out of the window. Puts is no more a option for us because puts we realized were more of a black swan event. Otherwise, you just end up losing your premium rather than anything else.
Yeah, month on month you
Just
do.
give you a notional. It just gives you a notional hedge and nothing else beyond
Actually,
that.
yeah.
So we said actual stock shorts is what we should be having. So today, if you look at our portfolio, we have anything between 20 to 25 stocks which are short at any given point in time in our portfolio. And these are actual names, X, Y, Z, and stuff like that. In fact, you get a lot of options, by the way, in the market to short. The only thing is that you should have that expertise. And we believe we've developed this over 17 years and we are quite home and dry.
Amazing.
Yeah, so that's what it is. So actual stock shorts, you can use the index, but only temporarily. So suppose you look at if you feel the market is going to be falling off the cliff, suppose something like today, Japan increased the hedges and you felt that probably markets are going to crap out in a big way and stuff like that, which we didn't do. But just to cover your position at that point in time, probably you can short the index, but over a period of time, substitute it with stocks. So you keep replacing. Suppose you shorted 5% of the index, but then you added X name of 1% to reduce that to 4, then another 1% reduce that to 3. So you use that as an immediate hedge, but then replace it at some point in time. So that's what we do, and that's why we are probably so successful in our long short fund per se. So
I just want to highlight here that those who are there listening to us, well, the number looks very easy to understand. But to run this, you require a different mindset altogether.
Totally.
To see that, your long only is losing year on year for 5-6 long years. And then in order to protect the downside, you require a different thought process altogether. And I'm not able to even visualize when you are speaking with us, Dinshaw, that what sort of patience requires, when you see intentionally you want to lose out on the long side because you're not going beyond 60 and from 80 you're going down to 60,
So Vikas, actually we keep shifting the hedging. I mean, it's not that we are purely married to that 60. That 60 is an average of the year, okay? At certain point in time, in fact, at the time of demon, we were the lowest. I think we were at some net 5% or something. So that's how low we had gone in demon as such. In fact, even during the present year, when the war broke out, I think we were at some 25-26% or so in the net basis. So that's how we keep playing around with our net as such. And that's why that average is 60. So sometimes you'll see 80. In fact, at the time of when Mr. Modi was announced as the candidate for the prime ministership, which was September of 13, we were at a massive gross as such because we were like almost close to 100% on net basis, but we still had a short book running with us. So that's how we keep playing this as such. So there you can leverage, right? So we are at that point, I think we were 130 long and some 50 shorts on net 80 and stuff like that. That's how it was. So that's how aggressive we can be on both sides of the book. And that needs to be done on a real-time basis. You can't just sit and say, okay, meri book itni hai, I'll just sit there and I'll just see how it works out. It doesn't work that way. So that's how the aggression comes in. And by the way, one more thing that I would like to highlight here is we are not technical believers. We do not believe in quants per se. We don't have a quant analyst with us, but still we short. And that shorting is mainly fundamental driven. It's pure fundamental shorting. We do not short on valuations. We don't think that valuations can be out of whack for a very long time, and that can take away a lot of money, right? But we do short on valuations only when we see an event building up. For instance, like some of the paint companies that we shorted earlier was mainly they were anyway stretched on valuations, 70, 80 times forward earnings. But then the crude oil started bloating up, and we realized that it's a matter of time before the consumer ultimately pushes back on the price hikes and stuff like that. And that's what happened, right? So we shorted and margins came off and the stocks came off and stuff like that. So that's how we keep playing around. And there are lots of examples like this, not only paints, even in the diagnostics business, we did that. In pharma business, we did it, which are like pure bread. In fact, today we're doing it in IT because really IT is overpriced. And I think it's a matter of time before IT starts crapping out. So that's what we keep doing that.